Today, danger, major inversion ahead. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and prop news with a distinctively Australian flavour. Well, US stocks climbed on Tuesday as growth stocks sidestepped growing expectations for the Federal Reserve to turn more aggressive on rate hikes, while meme stocks, including GameStop, returned to rally mode. But the real signals coming from the bond market suggests recession ahead. The Dow Jones Industrial Average gained 0.74% to 38,805. The S&P 500 rose 1.13% to 4,511, whilst the Nasdaq rose 1.95% to 14,108. Inflation remains a major concern, as Federal Reserve Bank of St. Louis President James Bullard stressed the need for the Fed to move faster and more aggressively on rate hikes to curb the pace of inflation. Those remarks arrived a day after Fed Chairman Jerome Powell said the central bank would be prepared to hike by more than 25 basis points at upcoming meetings to ensure, quote, a return to price stability. Wall Street was quick to price in steeper hikes following Powell's comments, with Goldman Sachs now forecasting a 50 basis point hike at the Fed's May and June meetings. Rising rates, of course, helped the bank's margins, so Wells Fargo rose 4.4% to 53.39, while JP Morgan rose 2.13% to 142.62. And growth stocks of the market, including big tech, didn't waver under the pressure of rising yields, with Meta Platforms, Amazon, Microsoft, Alphabet and Apple all ending the day in the green. And Chinese tech stocks were also in the ascendancy, supported by a surge in Alibaba Group after the e-commerce player announced that it had boosted its share buyback program to a record $25 billion. And Tesla, meanwhile, jumped by more than 7% after the electric vehicle maker officially opened its Gigafactory in Berlin. The move is expected to boost Tesla's market share in Europe. The opening of Giga Berlin should further vault its Tesla's market share within Europe over the coming years as more consumers aggressively head down the EV path, Wedbush said in a note on Monday. And on the earnings front, Nike, a sizable Dow Jones Index component, rose more than 2% after reporting better than expected quarterly results. Recent results and commentary from senior leadership of the company shows clearly that Nike is managing well its various external headwinds, including ongoing supply chain disruptions and geopolitical tensions across the globe. Oppenheimer said in the note, "We are optimistic that money will soon flow back into Nike shares." Energy stocks gave back some of their gains from a day earlier as oil prices turned a little negative on signs the European Union is unlikely to join the US in banning Russian oil. That said, WTI oil was at $108.98, up 0.21. And Tuesday also marked the return of retail investor appetite into the so-called meme stocks. And the thing about meme stocks is that sometimes they move like meme stocks. Shares of GameStop were up 30%, and AMC Entertainment were up 15%. Both rocketed higher on Tuesday and helping to create a draft for related names such as Bed Bath & Beyond, which is up 2.26%, and Hycroft Mining, up 5.65%. Some new and old meme names apparently benefiting from bullishness by retail investors on Reddit. While the trading day gave rise to the growing meme portfolios of GameStop chairman Ron Cohen and AMC CEO Adam Aron, it was a morning move on GameStop that appears to have incited the buying spree. And this is all traced back to a Reddit post by user Thump4 that went up early on Tuesday morning on subreddit Wall Street Bets, which proposed that GameStop stock was trading at a 58.2% discount to its 15-month fair value. Thump 4 used a chart of the stock's implied volatility and some options projections on contracts that suggested a calls to put ratio almost 2-to-1 into 2024. And the post also purported to show that GameStop's price had already double bottomed in 2022. Thump 4 pointed to growing options activity on GameStop as a potential signal that short interest had peaked, playing into a larger thesis that the 15-month price target on GME was $225 a share. The stock closed at $94.20 on Monday, but after the Reddit post received a few thousand upvotes, GameStop shares became the belle of Tuesday's market bull, closing up 30.7% on the day to $123.15, nudging it closer to Thump 4's target price. Slightly under 14 million shares of the video game retailer also traded on the day. That's more than 4 times its daily average volume. The last time trading in GameStop shares was this frenetic was August 2021. The post was on our radar in pre-market due to the fact that it was the most upvoted and most discussed post on Wall Street Bets, said Ivan Kosovic, founder of Breakpoint, a data group focusing on meme stocks. Maybe this started snowballing. It happens with meme stocks. Regardless of what else may have triggered the huge move on GameStop, a wider lift took place across a sector of meme stocks following that play. And talking of craziness, at the beginning of March, nickel was trading at around $25,000 a tonne. Since then, nickel has become more valuable as Russia's invasion of Ukraine has put pressure on nickel supplies. Due to a short squeeze on the London Metals Exchange, nickel futures shot up and the price climbed above $100,000 per tonne early on the morning of Tuesday, March the 8th. In general, the point of a futures market is to discover the correct price for a commodity. But in the case of the LME nickel, everyone, or at least everyone running the LME, sort of looked around and said, well, this is not the correct price of nickel. The chief executive officer of the LME said that the trading prices were becoming disconnected from, I believe, physical reality. The LME and many big metal traders decided that the correct price of nickel was not $100,000, so the LME cancelled last Tuesday's trades, a pretty drastic step that took away the profits and losses many traders had made on nickel that morning and rolled the price back to $48,078. Now it's down to $28,299 with a fall of 9.82% in more price-limited action, which, by the way, is now more closely aligned with the Shanghai market. And so you can add another leveraged nickel trade to the long list of wipeouts in the historic turmoil rocking the metal. And to add insult to injury, the Wisdom Tree nickel 3 times daily leverage exchange traded commodity, ticker was 3NIL, is being compulsory redeemed, issuer Wisdom Tree Investments said in a statement dated March 21. The London and Milan listed product, which used swaps to treble the return of nickel futures, had at one point surged more than 600% this month, before the LME controversially halted trading in the metal. When the market eventually reopened on March the 16th, nickel fell by the most allowable for 4 days in a row, delivering a fateful blow to 3NIL. The limitation on trading imposed on the nickel market by the LME after the 7th of March 2022 led to severe disruptions in nickel trading and pricing, which prevented the product from being priced and resetting its leverage at the end of each day as usual, Wisdom Tree said in the statement. While 3NIL was relatively small, it was among a breed of controversial leverage products that offer almost any investor easy access to often complex strategies teeming with risk. The nickel ETC also gave them entry to a relatively specialized market, typically the preserve of sophisticated traders and qualified firms. So once and again, another example of retail investors being taken to the cleaners. Which, by the way, takes us to the bond markets, which is another example of crazy position taking and over leverage. But note this, the bond market's most reliable gauge of the US economic outlook for the past half century is hurtling towards inversion at a faster pace than it has in recent decades, raising fresh worries about the economy's prospects as the Federal Reserve begins to consider aggressively hiking interest rates. The widely followed spread between the 2-year bond and the 10-year Treasury shrank to as little as 13 basis points on Tuesday, and that's just a day after Fed Chairman Jerome Powell opened the door to raising benchmark interest rates at more than 1/4 percentage point at a time. Though slightly higher on the day, as at Tuesday afternoon, the spread is down a little from where it was at one stage, 130 basis points last October. Investors pay close attention to the Treasury yield curve, or the slope of market-based yields across maturities, because of its predictive strength. An inversion of the 2 10s has signalled every recession for the past half century. That's true of the early 1980s recession that followed former Federal Chairman Paul Volcker's inflation-fighting effort, the early 2000s downturn marked by the busting of the dot-com bubble, the 9/11 terrorist attacks, and various corporate accounting scandals, as well as the 2007-09 Great Recession, which was triggered by a global financial crisis, and the brief 2020 contraction fueled by the pandemic. Inversions have already struck elsewhere along the US Treasury curve, suggesting the dynamic is broadening out and could hit the 2 10s soon. Spreads between the 3, 5 and 7-year Treasury yields versus the 10-year, along with the gap between the 20 and 30-year yields, are all now below zero. The yield curve has the best track record within financial markets of predicting recessions, said Ben Emmons, Managing Director of Global Macro Strategy at Medley Global Advisors in New York. But the psychology behind it is just as important. People begin to factor into their minds interest rates that are perhaps too restrictive for the economy and which will lead to a downturn. This chart, which by the way was compiled back in February, shows how the 2 10s inverted ahead of past recessions, and it's continued to flatten this year. The 2 10s most recently inverted for a brief time back in August and September of 2019, just months before a downturn sparked by COVID-19 hit in February to April of the following year. Ordinarily, the curve slopes upward when investors are optimistic about the prospects for economic growth and inflation, because buyers of government debt typically demand high yields in order to lend their money over longer periods of time. And the contrary is also true when it comes to a flattening or inverting curve. 10 and 30-year yields tend to fall or rise at a slower pace relative to shorter maturities when investors expect growth to cool off. This leads to shrinking spreads along the curve, which can then lead to spreads falling below zero in what's known as an inversion. An inverted curve can mean a period of poor returns for stocks and hits the profit margins of banks because they borrow cash at short-term rates while lending on longer ones. Though it slightly steepened on Tuesday, the 2 10 spread is still flattening at a pace much faster than it has at any time since the 1980s, and is also closer to zero than at similar points of time during past Fed rate hike campaigns, according to Emmons of Medley Global Advisors. Ordinarily, the curve doesn't approach zero until rate hikes are well underway, he says. And of course, the Fed delivered its first rate hike since 2018 on March the 16th, and is now preparing for a 50 basis point move as soon as May, with Powell saying on Monday that there was nothing that would prevent such a move, though no decision has yet been made. Some market participants are now factoring in a Fed funds rate target that might ultimately get above 3% from the current level of between 0.25% and 0.5%. But meanwhile, Powell says the yield curve is just one of many things policymakers look at. And he also cited Fed research that suggests that spreads between rates in the first 18 months of the curve, which are currently steepening, are in fact a better place to look for 100% of the curve explanatory power. But it's the 210 spread, though, that comes with a proven half-century track record. And it's fair to say that whenever the spread is about to invert, observers have cast doubt on its predictive capabilities. Usually the yield curve is an excellent look into the not-too-distant future, said Jim Vogel of SHN Financial. Right now, however, there are so many things moving at the same time that its accuracy and clarity have begun to be diminished. One factor is terrible Treasury market liquidity resulting from the Fed's move away from quantitative easing, as well as Russia's invasion of Ukraine, Vogel said. People are not necessarily thinking, they are reacting. People are not sure what to do, so they're buying 3-year maturities, for example, when typically people are more thoughtful about their choices, and those choices actually go into the accuracy of the curve. He sees the spread between the 3-year and the 10-year yields, which just inverted on Monday after Powell's comments, as a better predictor than the 210s, and says that a sustained inversion of 310s over 1 or 2 weeks would lead him to believe a recession is on the way. And on Tuesday, Treasuries continue to sell off sharply, pushing yields higher across the curve. The 10-year yield rose to 2.38%, while the 2-year yield advanced to 2.16%. So, standing back, the stagflation signals, it seems to me, are certainly gathering apace. And what happens over in the US will have a profound impact on our local markets here. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.